Well, hello everyone and welcome to this week's video. This week I thought I would just attempt to answer one of the more common questions that I'm asked by students and by investors, and that is simply, is this the right market to invest in? Although the question sounds easy, the answer is a little more involved, and I'm going to work through an explanation with you looking at the numbers. The second most common question that I'm asked by existing investors usually goes something like this. They're an investor, they've owned for the last 2 or 3 years, they've lived through the COVID thing, and they've typically had problems collecting rents from tenants. The short story is they're very stressed out over their investment and they're tired of being a property manager, and the big question asked of me is simply, how do I get out of this mess? I'm going to answer that question in another lecture which I'll post next week. So be looking for that. Let's get back to this week and how are we going to answer that question? Is this the right market? Let's go ahead and start with an example of a property which is currently for sale in my local market. This is a single-family residential home and it is selling for $750,000. This investor has a pre-approval for a loan of $525,000 and the interest rate is 5.25%. It's a 30-year loan, so there's 360 payments. Generally speaking, in this market, the rental rate would be about $3,500 a month for this property. And the property taxes would equate to approximately $9,000 per year, so that's a hefty amount. The insurance would be roughly $1,900. Landscaping fee is roughly $125 a month, which equates to roughly $1,500 a year. Repairs and maintenance work out to be $2,400, and the management fee is equal to about 4% per month of the effective gross income, and that will equate to, on a yearly basis, of approximately $1,680. So let's take those numbers, input it into our investment model, and see how they look. Okay, let's get started on that right now. All right, let's go ahead and take a look at all the numbers now. As you recall, the rental rate is $3,500 per month. On a yearly basis, that works out to be $42,000. There's no other income at this property, so the scheduled gross income is $42,000. Then there's no vacancy, so my effective gross income works out to be the same thing, $42,000. So the total operating expenses equals $16,480. If you subtract that from the effective gross income, your net operating income is $25,520. The next thing I looked at was the loan. If you recall, the loan is $525,000. The interest rate, 5.25%, and it's a 30-year loan, 360 payments. The total payments per year work out to be $34,780. All I did here was break it down between principal and interest so that we can calculate our taxes. Moving on down. The cash flow after debt service now works out to be a negative $9,268.83. You can see the other years here. At this point, I can tell you that it will be difficult for any investor to get this loan unless they have a fairly strong balance sheet or also other investments or money in the bank. It's going to be difficult. But they are out there, lenders that will make that kind of a loan. Then going on down, all I wanted to do now is look at the return. So, okay, how does this all work out? How much money do I actually make over a projected 5-year holding period? Well, I calculated taxes first. Net operating income, $25,520. That's up here. Your interest expense, $27,386. Depreciation, I won't go into those calculations. On a yearly basis, $21,223, which brings me to a taxable income of a negative $23,089. If that is indeed the case and I have a passive loss of $23,000, I may be able to offset some of that against my ordinary income. In fact, I can probably offset up to $25,000 per year against my ordinary income. By doing that, I will save taxes on my ordinary income. There is limitations on that. So check with your accountant. I'm assuming you'll be able to do that. If I can subtract that from my ordinary income, I will save $6,927 if I'm in a 30% tax bracket. Given all that, if my cash flow before taxes is $9,269, which we have here, I subtract out, or in this case add back into it, the tax benefit of $6,927, this number, I save on taxes. Adding those two numbers together, on a yearly basis, I have a cash flow after taxes of a negative $2,342. A lot of investors will find that to be intriguing. But again, I want you to concentrate on this. The cash flow before taxes, you will actually be out of pocket $9,268. That money will be spent on a monthly basis and will total in the year $9,268. But at the end of the year, when you take into consideration the tax savings, it will only be $2,342, a negative. All right. Also, look at this these cash flow lines here. Cash flow after taxes. My down payment plus the costs, $236,000. That resulted in this cash flow, which also includes the sale of the asset. So my cash in that you put in your pocket, $293,767 at the end of year 5. Okay. So what does all that mean? What is the return? If you calculated your internal rate of return, which equates this line, my cash flows each year, to the outflow of $236, the return works out to be 3.79%. But there's another number that I like to calculate, and that is shown down here. And what I've done is I've partitioned this internal rate of return between its components. Again, the components are cash flow, tax benefit, and appreciation. That's all that makes up the return. When I do those calculations, which was done here, it breaks down that rate of return of 3.79 between these items. The return on the cash flow was a negative 0.62%. That's this up here, these numbers. The tax benefit on there was basically a break-even, 0.01. Okay? Appreciation, 4.4%. So the internal rate of return was a total of 3.79, but the appreciation was 4.4. The reason why it went down was because of these two components were negative. So the total return, again, is 3.79%. So what does all of that mean? Looking at this, well, if the cash flows are negative and the tax benefit is just at zero, well, then the whole investment is back-end loaded, which just means your total return is coming from the end, and that's the most risky part of any investment, if it's back-end loaded. Now let's get back to answering the question at hand. Should you invest in this property? And my answer would be no. And there's a number of reasons I wouldn't do it. The first is the return on the property. It's under 4%. Okay, and if a property doesn't achieve a minimum return and I look for something somewhere around 15%, then I'm just not interested in it because there's little I can do to raise the return after the purchase. There's also some other issues with this investment. One of them is the negative cash flow, or the cash flow after debt service. That was over $9,000 on a yearly basis, and that's a little much for anybody to handle. I'd be looking for something that gets closer to breaking even. On a personal level, I'm not that interested in the cash flow from it. I just don't want to be feeding it every month. So the cash flow is a big deal for me. That's just too far out of bounds. There are other steps that you can possibly take to increase the returns. One of them would be to ask for a lower price from the seller. But I think that's stretching it a little bit. That seller of the property is selling at what normal houses sell for. The fact that you're using it as an investment and would need a lower price to make the numbers work, that just won't carry any weight at all. So lowering the price is not going to work. Also, you could increase the return by decreasing the amount of the loan. That's because it has negative leverage, and that's a topic I go into in my class, Real Estate Investing for Everyone. It has negative leverage, and so by increasing the amount of the loan, the return goes down, or just the opposite. By decreasing the amount of the loan, the return goes up. So you could do that. The bad part about that is as soon as you reduce the amount of the loan, that increases the amount of cash that's needed to close the transaction. And there you go. That's probably not a viable option. All right. So there isn't really much to do on this property. It just doesn't make it as an investment. The whole point of all of this, though, is evaluating potential real estate investments. And if you would like to learn more about that, you might want to consider taking my class, Real Estate Investing for Everyone, where I go through each of the concepts and more of them that we discussed here. I go into them in much more detail and lay it out exactly how I would approach the property. Okay, well, I hope you enjoyed this and look for the next one coming up soon. And that would be on getting out of an investment that you just don't feel is working for you. Okay, thank you, and we'll see you in the next one.